You're about to hear my conversation with our chief fixed income strategist, Dustin Reed. We talk all about the Fed, their recent decision, as well as the Bank of Canada, and the current state of trade relations with the US and rest of the world. I hope you enjoy. This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Listeners should seek professional advice for their situation. Welcome to Market Exchange, a podcast from Mackenzie Investments. My name is Matthew Schnurr, and I'm delighted to be back with Dustin Reed, our chief fixed income strategist. Dustin, welcome back.
Matt, great to be back with you.
Let's start with the Fed. They just met yesterday. Maybe start with some high-level comments on your reaction to them staying pat, which was largely expected. But give me some comments surrounding that.
Yeah, for sure. So Fed obviously met this week, the July meeting, not a forecast meeting, so not a new dot plot as it goes, or estimates. As you said, Fed on hold. Very little was priced in going into the meeting, maybe a basis point. July has been kind of off the radar for a rate cut for a while. So have the main statement to focus on as always, as well as Powell's press conference. So the main statement had a couple of little changes. A couple of people viewed that, or maybe some minority of people maybe viewed that as slightly dovish, but there really wasn't anything overly material in terms of changes in the statement that really got the market going. There really wasn't a lot of movement in that half an hour between kind of 2 and 2:30 Eastern. Market did start getting a bit excited after the 2:30 press conference started with Powell. That ended up being quite a bit more a hawkish event than I think people had expected. Now, in the statement, we did have two dissents from governors, which is extremely rare. Even one dissent from a governor is quite rare.
Right.
Two dissents has not happened since 1993, which is obviously a Greenspan era type stuff. It's a long, long time ago. So that had not been completely unexpected, but then Powell seemed to really dig in during the press conference. You know, sometimes, and like I said to a few people on the team here, sometimes it's about what's not said as opposed to what is said. And this time, Powell did not necessarily reference the June dot plot, which is the last forecast round for the Fed. He did not say something along the lines of, and I'm paraphrasing a little bit here, but something along the lines of, you know, a lot of the majority of members, or a lot of members or participants still believe that we will see rate cuts or more than one rate cut later this year. He refrained from saying something like that when he often says comments in and around that type of thing at the non-forecast meetings, which again, the meeting this week, the July meeting, was. And I thought that was quite interesting. So coming out of the June meeting, not the meeting we just had, but the meeting before, it was very clear. We talked about this on the previous podcast, I think. It was very clear that the Fed believes, rightly or wrongly, that we would be seeing tariff-related inflation pass through on the good side for the June data printing in July, and the July data that prints in August, and maybe beyond. And so since the June meeting, but before yesterday's meeting, the July meeting, we did get the June CPI data and inflation data, right, that printed in the first half of July. And that data, some people see it a little bit differently, but a number of people, I think, saw that in tariff-related inflation pass through to a number of goods sectors that are really being affected by tariffs, things like apparel, music equipment, sports equipment, furniture, a bunch of stuff. And it's first month, and it's not massive, but it was clearly there. And so after that inflation data came out earlier this month, July, which was the June data, I said, you know, the way I would look at this is the Fed probably believes that its inflation theory about tariff-related inflation pass-through has not been disproven. Right. And so that is very much, and bring this all back to the Fed meeting, that is very much along the lines of the tone and the wording that I heard from Powell yesterday watching the press conference. Our views around inflation, our theories around inflation, particularly around tariff-related inflation pass-through, have not yet been disproven. And so I think that really gave off a very hawkish tone from the press conference for the market. So just for perspective, going at least in the morning, going into the day, the session, market was pricing maybe 17 basis points of easing for the September meeting and 46 basis points cumulative for the rest of 2025. Closing yesterday, or at least coming into my 8 o'clock meeting this morning, those numbers had shifted for September from 17 to about 10 or 11, and for full calendar year inclusive or cumulative from 46 to 34. So that gives you a magnitude of how much the market had taken out, which is a significant amount. It's certainly not a massive amount, but it is a significant amount. The last thing I'll say maybe on this, and we can open it up for maybe more if you want to talk more about the Fed or the outlook, but Powell really emphasized that he thought that the labor market was in a very good spot. And clearly things can go the wrong way very, very quickly, but he thought that the labor market was in a very, very good balance. And heading into NFP tomorrow, it's very clear that at least for now, this Fed is more focused on the unemployment rate as a signal of where policy should go, as opposed to kind of the big headline number, 150,000 jobs created, or whatever the number is. I think they are much more focused on the unemployment rate, and so I think the market's going to skew a little bit depending on how the numbers come out for NFP. But that takeaway that tariff-related inflation pass-through is still there and potentially going to be there and maybe accelerate, and the labor market is in better balance or continues to be in good balance, seems to take a little bit of the shine off of a September rate cut, and the market has reacted accordingly.
Great context. I guess my only follow up is on the Waller and Bowman in their position, which you've pointed out hasn't happened since '93, very rare. And then based on your comments, so dual mandate, obviously, at the Fed, both inflation and full employment. If employment appears to be fairly solid, which I think there's suggestions that it might be weakening somewhat around the edges from some camps, but it's largely fairly good. And inflation has ticked up a little bit. Is it just a nakedly political act? Because obviously we know the back history with Trump and Powell and the saga there from Waller and Bowman, or is there more substantive, I guess, objections to the decision?
It's tough to know for sure. It's a great question. A lot of people are talking about it, obviously, and that's definitely a thematic in the market. I tend to think for those two individuals in particular, it is not political. Um, Waller used to be the head of research for the St. Louis Fed, the district bank, under Bullard, and of course Bullard was on the committee as a voting member, non-voting member for a long time, and then Waller joined him with one of the open governor spots, and Bullard has subsequently left and gone to teach in Indiana. I mean, I think Waller is clearly on the short list for the job
Sure.
as Fed chair. And if you look at Polymarket or Clashy and the betting odds, he's on the list of 4 or 5 people that are there. But I don't think he is acting politically. He's been on this tangent for a while. I'll say months, a number of months. We've talked about it, I think, a little bit before
Yeah.
on these podcasts. I mean, Waller's view, if believed, and I tend to believe him, is that we are seeing, well, there's two things, both to your point on the dual mandate. On the labor market side, Waller believes that we are seeing some maybe somewhat significant fraying in the labor market. And he would focus quite a bit, not on the unemployment rate, but on how private payrolls are performing. So when you see that NFP number, the big headline, 150,000 or whatever the number is, 100, 150, 200, other, that number is all, in theory, all jobs. I mean, it is what it is, non-farm. So it's basically everything in the economy without farming jobs. But that includes public sector jobs. And so, of course, you can strip out the public sector government jobs and see what the private sector is creating in terms of new job creation month by month. And when you do look, and I've been on this for a while, and I don't think he's wrong. I actually have a lot of sympathy for the view. When you look at the number of jobs that the private sector is creating, it's significantly less. For example, the June NFP data, which printed in early July, I might be slightly off here, but I think I'm correct. there were only 78,000 private payroll jobs created for the month, which is significantly less than the overall number that printed. So that is, that's significant. And obviously, the theory would be, as I'm sure people would understand, if the private sector is not able to create a lot of jobs and the job growth is only coming from the public sector, that's not particularly healthy,
Right.
right? To take an
Sure.
extreme example, if you had 150,000 payroll print and 150,000 of those were public sector and zero were private sector, you'd say, well, that's probably not great, even though it's 150,000 new jobs created. And so Waller's kind of along that tangent on the job side. And on the other side, from the mandate, he very strongly believes, and I don't think this is a political thing. I think this is his way of thinking. I think he believes that inflation is the tariff-related inflation pass-through is extremely temporary, and that's kind of got a bit of a rough go, obviously, given what happened in the pandemic era and the Fed. But he really thinks it's kind of a one-time level price increase, and then it doesn't really repeat itself again over time. And there's obviously a lot of academic literature and debate around whether that is true or whether it is not. But as the former head, and that's why I mentioned it before, as the former head of research for one of the district banks, he's got some purview into, I mean, everyone has an opinion, but he's got some pretty good latitude in terms of how this works from an academic perspective. So that's his view, and that's why he thinks that the Fed should be cutting. I mean, kind of stepping back a little bit too, you have this, it's always this thing in central banks where you have a forecast. How much do you believe the forecast? How much do you want to be anticipatory of what you think that forecast is going to do and if it's going to be correct? Or how much do you want to wait to actually get confirmation before making policy actions? And Waller is clearly, at least at this stage of the game and the cycle, being a lot more within kind of the proactive, let's get ahead of it idea, as opposed to, I think, others on the committee that are saying things seem okay, and if it's not broke, there's no need to fix it, especially given that we think that current Fed funds at 4.25, 4.5 is still moderately restrictive.
Yeah, fair enough. Totally a reasonable perspective. So thanks for illuminating that and going into that with some detail. Let's move to Bank of Canada. Also, recent meeting from Bank of Canada. Also, no changes to interest rates. What's your view on the path for Canada and any differentiation from U.S.?
Yeah, absolutely. So Bank of Canada met this week as well. No change, as you said. So policy rate in Canada quite a bit lower than the U.S. still at 2.75%, 2.75%, and the Fed is, like I said, a range of 4.25 to 4.5. So it's a pretty big gap. So Canada has obviously done a lot more on the rate easing cycle so far than the Fed since they both got going at the beginning, at the peak. So July meeting for the Bank of Canada is a forecast meeting, so we got a little bit more detail about what the bank was thinking. There were a few interesting takeaways, I think, from the bank. One, somewhat surprising, I think, and somewhat changing its tune. It seems not as concerned about inflation, and in particular, I would say core inflation, as it did in Q2. There's been a lot of Q2 thinking and looking at the core inflation numbers for the bank, well, at least for the country, and how the bank would interpret it, and how other people on the street were looking at it. And a lot of people thought the bank's putting a lot of emphasis on core inflation, and it seems to have backed off a little bit now on that, and thinks that inflation can come a little bit lower here. So I think that's one big takeaway. I think another takeaway is that the bank got a little bit unlucky in terms of timing. So everyone remembers, of course, Liberation Day, which was April the 2nd. And then there was a week of, craziness. There was actually more than a week of craziness, but a real week of craziness.
Right.
And then on April 9th, there was basically a 90-day reprieve that went to July 9th. And then the July 9th date, a few weeks before it, there was another 3-week reprieve that went to August the 1st, which is, as it happens, we're recording on the 31st, so it's tomorrow. And obviously a lot's happened on the trade side kind of since then. But the bank, with its fixed date on the 30th, July 30th, probably thought it would have more clarity on the 30th because of the July 9th original or semi-original date.
Right.
That, of course, did not happen. And so I think the bank was hoping to be able to make a more of a solid statement in terms of the outlook going forward than it was able to do because it really doesn't know on the trade side. And I think, again, we can talk about it if you want, but there's probably some risk around Canada-U.S. trade deal here in the interim. So I think that made things a little bit more challenging. And then the bank, because it was a forecast round, the bank believes, and the street kind of believes this too, that Q2 growth is going to be quite weak. And the bank actually has Q2 growth at minus 1.5% now, annualized, which is a pretty weak number. You don't see that too often, thankfully. It does expect growth to rebound in the second half of the year, but a lot of that is trade dependent, of course. And so my view on the bank for a while has been that the market is underpricing the probability of additional cuts from the bank. We had the March call correct, looking for a cut when most people did not have that. April was not, they did not cut. I thought they would cut again based on the same rationale from March. That didn't happen. And then we had them on hold in June. And the bank here at 2.75% is in the middle of what it calls its neutral range. And so it really doesn't think that the main policy interest rate for the economy starts to be accommodative for the economy until it gets to 225 or even below. And so I've always thought, or at least I've thought for a long time, that there are at least one, if not two, cuts that are available, kind of cushion cuts within the neutral range that don't even get you to accommodative status, according to the Bank of Canada's own literature. And so when I see things like, well, Q2 may be printed minus 1.5, and we're not overly concerned about core inflation as much as we were, and we think inflation can come lower. And obviously, there's some risks around trade. It's already happening, of course, given all the stuff that we've had, and everybody knows that's happened year to date so far. But there's still things ahead of us. Kind of wonder. At least my sequencing is, I kind of wonder why not get a little bit closer to 2.25. So I do think that there are more cuts possible for the bank here in the next few months or quarters. The market, given what we said before around the Fed and pricing out the Fed in kind of the very short term, the market has also priced out Bank of Canada probability on cuts as well. But I think that's more kind of a beta around what's happening with the Fed. And so, there's very little priced in terms of Bank of Canada. When I looked this morning, there was only about 11 basis points priced, 11, 12 basis points priced for the Bank of Canada in terms of cuts for the rest of the year. And there are 3 meetings now the rest of the year for the Bank of Canada, September, I believe October, and December. And I think that 11 basis points is quite low, particularly if the trade negotiations that are imminent here as we record this podcast do not go well. So I think that is a real opportunity for, depending how you look at it, depending what asset class you're trading. But if you're trading kind of short-term fixed income, I think it's a really interesting trade, and there's probably some implications around the currency side as well.
Great. Well, I'd like to dive into some more there. Why don't we start with the trade deals that you referenced a few times? As a Canadian, I am feeling a little left out. We've heard the trade deals with Pakistan, South Korea, EU, Japan, Philippines, Indonesia, Vietnam, UK, and just minutes ago, they're delaying a Mexican trade by 90 days, it looks like, at least as we speak now. So what is your view on Canada US trade deal? Why do you think we haven't come to an agreement? And you don't have to do any short-term predictions, but over the medium term, where do you think we land?
I think a deal will be hammered out, and I do think that USMCA is still, very, very live. I think one of the reasons kind of the short-term deal hasn't been hammered out is probably because Trump and the administration wants to use it as leverage for USMCA negotiations as it comes for renewal later this year and into 2026. And I think we're very much in that space right now. I'm not obviously in the negotiations, but I think that Carney and team, LeBlanc and team have been very steadfast and very purposeful in terms of their negotiating. And no, I don't want to say no deal per se, but under this catchy idea, no deal is better than a bad deal. I don't think they're aiming for no deal, but we're not going to sign a deal at any cost. Is probably a slightly better way to say it. And I think that's very much the MO of the Prime Minister's office and the people around him that are advising on trade. I mean, clearly, to your point, we've seen a lot of deals happen here. I mean, just this morning, it looks like not a deal to be fair, but another 90-day extension on the Mexican negotiations. It looks like China's going to have another extension on its negotiations that was due mid-August. That probably goes to around to mid-November, give or take. The European deal that got signed was surprising for a lot of people in the market. And we've seen a pretty significant market reaction on the back of that. Risk has performed quite well. The dollar has massively outperformed as well. Euro has underperformed in the last week or so, having outperformed really since Liberation Day. So it's been a real interesting inflection point. I think a lot of people did not expect the European deal to get done and even get done at that level, 15%, give or take. And that has been significant. And you've seen a lot of bite back in terms of internal squabbling, for lack of a better term, within Europe. A lot of European leaders and senior people within the bureaucracy saying, "Look, this is a terrible deal for Europe," and maybe it is, maybe it's not. I don't want to necessarily opine whether it is or it isn't, but the optics and the implications seems that it was. And the Trump administration, like them or not, is clearly feels that they have a lot of momentum, and they are collecting around $30 billion a month in tariffs at this point. I mean, they're running at almost a 350, 360 billion run rate, and it's a lot. It's a lot of money, and it's helping to offset some of the tax cuts that just got done, obviously within the fiscal side from the BOBA, or the big beautiful bill, as it's kind of called in the press, but OBBBA is actually the proper acronym. And I think we've seen a change in sentiment here, not only from the administration in terms of we really have momentum and we really think we can get the deals done that we want, but you can feel that momentum and sentiment swing in the market, whether that's equities, fixed income to a point, FX for sure. Those markets, you can really feel it. And the trade stuff, after being obviously a massive driver for the beginning of the year, and then kind of taking a bit of a break back into June, maybe late May, June, after Liberation Day and all that, and has kind of come back and become a bit of a driver again, to the surprise of many. I agree with what you said at the top of the question. I feel a bit left out too, sitting here in Toronto. I think Canada's a bit left out, and Trump has said many times, we don't need Canada, and they now have, they have deals with Europe. I mean, deals in theory. I mean, there's a lot of things that aren't necessarily detailed out yet, and $600 billion in investment from Europe relies on national governments and private industry, and Ursula von der Leyen does not have the authority to tell countries to go and invest X billion dollars or X billion euros in the US. I mean, that doesn't happen. And everything needs to be ratified, as it often does in Europe, and with 27 capitals, and that's not easy. But I don't want to say it doesn't matter, but it doesn't matter, because the market is not trading about that. It's trading on the idea that sentiment is changing. The administration in the US has a lot of momentum, and markets are trading on the back of that. And you can't, this is part of my challenge often, as particularly as putting on my strategist hat, macro strategist hat. I might think that, oh well, like this may not happen eventually, and here are all the reasons why, legally and politically and all those sorts of things, and that's fine. But that doesn't necessarily matter because the market might just say, I don't care, and trade the other way. And you can't necessarily ignore that sentiment shift and that momentum. And so that's very much, I think, the environment that we are, in right now. And so, I mean, obviously a little bit of a challenge talking about dates, like a little bit of a challenge kind of recording this midday on the 31st ahead of the Canada announcement, or no announcement, as it were, tomorrow.
Of course, yeah.
But if there is no announcement, as this podcast sits out for a couple of weeks, I think it's a problem for Canada. And I would be concerned about kind of Canada versus U.S., Canada versus rest of world performance on a number of different fronts, a number of different asset classes for the foreseeable future. If, and we are recording ahead of time, so we'll see what happens.
Let's move into positioning in the portfolio. There's probably no better way to get a real glimpse on what you're thinking by talking about the trades that you've implemented in the portfolio. So, walk me through what you currently have on, and I'd love you to spend some time as well on currency. You referenced it. I think it's a really interesting market right now for asset class.
Yeah, yeah. Okay, great. Yeah, for sure. I think we'll start with the currencies then. I had a very strong view coming out of April 2nd, Liberation Day, that U.S. dollar was going to be structurally weaker over time, and that wasn't necessarily a 1 or 2 month trade. It was more I would think of it in quarters, maybe 3, 4 quarters, 5 quarters, something in there. And the idea behind that is that, given what happened and the fall in correlation between asset classes, that the U.S. may not be as investable. I'm not saying the U.S. is not investable; it absolutely is very investable. But just if you thought of, just very simplistically, from 0 to 10, if you thought the U.S. was investable from a, I don't know, put a number on 8.5 or 9,
Right.
maybe it goes to a 6.5 or something like that. And so a lot of these non-U.S. global portfolio managers, institutional portfolio managers, particularly equity portfolio managers who are underhedged, may not only need to start hedging, but also increase hedge ratios. And so that would be negative for the USD. So we've had a negative dollar view on against a couple of currencies for the past number of months, looking into, like, with trades that go into 2026, quite what I would call, for us anyway, longer term structural trades. And those were working very, very well. Great, until the European deal happened and kind of surprised a number of people. I would say myself included. And the euro has been, and all currencies really have been very, as we would say, offered again or sold against the U.S. dollar, which people have been buying the dollar as we close out the week here this week, almost on the 31st. People have been buying the dollar quite significantly all week, and so that trade had done quite well and has kind of come back against us. I mean, this is so those are options trade, so the mark to market's relatively easy. And their 2026 expiry. So we've got a long, long way to go on all these things.
Right.
But this idea of how investable is the U.S., where are the flows going to come from? Do you need to hedge? Is the Fed going to cut rates? Is the hedge ratio going to be, or hedge expense going to be cheaper? That whole thematic has kind of turned a little bit on its head this week. So that's been a little bit challenging, I think. And you've also seen dollar Canada move higher as well. So U.S. dollar higher, Canada dollar weaker. It's kind of gone from the 135, high 135 neighborhood to above 138, which is a pretty significant move given, I would say, dollar Canada volatility that we've experienced over the last couple of years. It's a pretty good move. And that's, I mean, there is some Canada stuff in there as well, but it's really more a U.S. or U.S. dollar story than I think Canada. So that's one set. We're relatively neutral in our hedge ratios in terms of dollar Canada, but we do have these FX options plays on against euro U.S. dollar, Australian dollar against the U.S. dollar. And I mean, I'm a little bit more concerned than I was. Also, the time has elapsed a little bit, but I still like the underlying structural view. But I will say, with a hawkish Fed, or at least the perception of a hawkish Fed, and we talked about it a lot already. Don't need to rehash it, but if the Fed does not cut in September and maybe is going to cut less this year, all other things equal, that's probably constructive for the dollar, and that changes, that kind of changes things a little bit. I am a little bit surprised that the market has fallen over itself. I mean, clearly, market was very positioned to be short dollars, and when it got some news the other way, it started short covering. I mean, it's classic short squeeze. I mean, you can't really give a better example. I mean, and again, that 600 billion euro investment into the U.S. I think a lot of people started buying dollars on the back of that as well. But again, my more kind of strategy brain says, well, who's actually going to do this? Because you can't mandate private sector. So, again, you have the market, I think, maybe getting a little bit ahead of itself, but you can't necessarily, ignore that. So that's one trade or a set of trades, at least within an asset class FX within the portfolio. The duration side has done very, very well for us and continues to do well, in Q2 and into the first month, obviously now finishing July in Q3. And we've been overweight US duration, generally not outright. Generally, we have it as we would call a spread product. So we long US duration against Canada, which has been a big trade for us. Long US duration against Europe, which has been big-ish, not as much risk as the US Canada spread trade, but also but decent risk. And we continue to like that, although we've been lessening the position in the US Canada rate spread trade, having come from minus 140 basis points to around 85 basis points this morning. So that has directionally gone the way we would hoped and expected it to go. So that's been a very good trade for us and our clients. And similarly, the U.S. Euro trade, which is really U.S. against Germany, has also gone in a similar direction, looking for that spread to narrow. And of course, these spread trades can work a couple different ways, but as long as the spread narrows, then you generally make money. We've been long New Zealand duration against Canada for a long time, but recently actually traded out of that, mostly because the trade worked and there really wasn't a lot of juice left in what we thought, given where the spread had gone. So again, looking for that spread to narrow between New Zealand rates and Canada rates. So we still kind of like the fundamental story, but we think it's basically in the price. So when things are in the price, you may like the story, but it doesn't necessarily mean you should have the trade on.
Right.
So we've actually got out of that. We've had that one on for quite a long time. Then on the EM side, we continue to like Mexico for the carry, although we've hedged about 50% of the exposure. We don't always hedge our EM local currency exposure. We often, not always, but often leave it open. But we've hedged this one just because of concerns over Canada. And we just talked about it a minute ago on this, right? And this is exactly the kind of thing, and the rationale why we're hedging it. So we've hedged some of it, which I think is probably a good idea. And we also continue to like Brazil from a carry perspective. The general view, back of the cocktail napkin thing on EM, is if U.S. rates are heading lower and the U.S. dollar is heading lower, it's generally good, not always, but generally good for emerging markets.
Right.
And we've had a bit of a wiggle here on the dollar side, and then we've had a hawkish Fed. So got to be careful around EM. And is EM as a carry play still where you want to have it? And so I think the answer is generally yes, but there's a big but. And the but is that, first of all, you have to be very, very sure that any kind of local idiosyncratic issues aren't going to get in the way. So that can always happen anywhere really, but particularly EM. And I'm specifically talking, the trades we have on now, so Mexico and Brazil. But the other thing is that you've got to make sure that whatever you're investing in, the carry is still very, very high. And so even if we have some issues within EM, Mex and Brazil, the carry, whether you look at it from a nominal perspective or from a real carry perspective, they are both so high that we think it gives us a lot of degrees of freedom in terms of cushion, even if EM and carry trades fall out of favor. So we're relatively comfortable with that, but obviously monitoring a fair bit given kind of the news flow that's happened this week with the Fed and a number of other key events that have happened, trade stuff obviously as well. So those are some of the bigger macro trades that we have on in the portfolio at this point. And like I've said many times this year, this will be a very, very interesting year for macro, and clearly benefiting those that are focused on active management and have some purview across different asset classes within both developed markets and emerging markets.
Well, Dustin, let's call it there. Thanks so much for spending the time, your insights on everything going on, macro and within the portfolio. Really appreciate it.
Thanks very much for having me.
The content of this podcast, including facts, views, opinions, and recommendations, is not to be used or construed as investment advice and is not an offer or an invitation to buy or sell any security. The content of this podcast should not be relied upon for any purposes, and Mackenzie Financial Corporation is not responsible for any reliance upon it. This podcast includes forward-looking information that reflects our current expectations or forecasts of future events. Forward-looking information is subject to risks, uncertainties, and assumptions that could cause actual results to differ materially from those expressed herein. Our views are subject to change based on market conditions. Commissions, trailing commissions, management fees, and expenses may be associated with mutual fund investments. Please read the fund facts and prospectus before investing. The indicated rates of returns are historical annual compounded total returns, including changes to unit values and reinvestment of all dividends or distributions, and does not take into account sales, redemptions, distribution, or optional charges or income taxes payable by any security holder that would have reduced returns.